Welcome to our lecture video. In this lecture, we are going to study project cash flow estimation. This is one of the most important skills in capital budgeting. Before we can decide whether a project creates value, we need to understand what cash the project will bring into the firm, what cash it will require, and when those cash flows will occur. A good project forecast is not simply an accounting report. It is a disciplined estimate of incremental, after-tax free cash flow. That means we focus on the cash flows that happen because of the project, not cash flows that would happen anyway. In project analysis, we normally organize cash flows into three broad categories. First, initial cash flows. These are the cash amounts invested at the beginning of the project. Second, operating cash flows. These are the cash flows generated by the project during its life, after considering revenues, cash costs, depreciation, and taxes. Third, terminal cash flows. These occur at the end of the project, when assets may be sold, working capital may be recovered, or shutdown costs may be paid. As we move through this lecture, keep one principle in mind: consistency. Cash flows should be incremental, after tax, and placed in the correct period. The discount rate should match the risk and structure of those cash flows. By the end of this video, you should be able to look at a business project and organize its cash flow forecast clearly and confidently. Let's begin with the overall structure of project free cash flow. I want us to focus on the business meaning behind the standard project free cash flow formula. It separates project cash flow into three main parts: operating cash flow, net capital spending, and changes in net working capital. Operating cash flow tells us how much cash the project generates from its core operations after taxes. This is the cash created by selling products or services, paying operating costs, and satisfying tax obligations. Net capital spending captures cash used for long-term assets. These may include equipment, buildings, technology, machinery, vehicles, or major improvements. It also includes cash received from selling project assets. Net working capital captures short-term operating investments. A growing project may need inventory, customer credit, and other current assets. Some of that need may be financed by operating current liabilities, such as supplier credit. This structure is powerful because a project can look profitable from operations and still consume cash. Why? Because it may require large capital expenditures or substantial working capital investment. At the end of the project, the same structure applies, but the final period often includes terminal effects. These may include after-tax salvage value, working capital recovery, and shutdown costs. The key rule is simple: include each cash flow effect once. If working capital recovery appears in the final change in working capital, do not also add it again as a separate recovery line. A well-designed forecast should make the logic visible. It should answer what cash is committed, what cash is generated, what cash is tied up, and what cash is recovered when the project ends. Let's now examine the initial investment outlay. The initial investment outlay is the net cash flow at the start of the project. It usually occurs at the beginning of the timeline and is normally shown as a cash outflow. For an expansion project, the initial outlay often includes the purchase price of equipment, machinery, technology, buildings, or other long-term assets. But the purchase price is only the beginning. Managers must also include shipping, installation, testing, training, setup, site preparation, permitting, and other launch costs. As long as these costs are incremental to the project, initial net working capital is also part of the initial cash commitment. If the project requires inventory before sales begin, or customer credit once sales begin, cash may be tied up right away. One important distinction is between cash flow and depreciable basis. Some costs may be capitalized and depreciated over time, but the cash is still paid at the beginning. The model must show both ideas clearly: the cash outflow when it occurs, and the depreciation expense later when it affects taxes. Replacement projects add another layer. If the firm is replacing an old asset, The old asset may be sold. The after-tax proceeds from selling that old asset reduce the initial cash outflow. Here is the managerial lesson. The beginning of a project often contains more than one cash flow item. It is not just the invoice price of the asset. It is the full cash commitment required to place the project into operation. Next, let's move to operating cash flow. Operating cash flow measures the cash generated by the project's operations after taxes, before considering capital expenditures and changes in working capital. One approach begins with operating earnings before interest and taxes. Taxes are applied to that operating income, and then depreciation is added back. Depreciation is added back because it reduced taxable income, but it was not a cash payment during the operating period. Another version highlights the depreciation tax shield. This version separates the cash operating margin from the tax benefit created by depreciation. That distinction is very helpful for interpretation. Revenue and cost forecasts should come from real operating assumptions whenever possible. Managers should think about expected units sold, prices, customer adoption, market share, capacity utilization, variable costs, fixed cash costs, inflation, maintenance, warranty costs, and effects on existing products. Notice that interest expense is usually excluded from project operating cash flow. Why? Because financing costs are normally reflected in the discount rate. If we subtract interest in the project cash flows and also use a discount rate that reflects financing costs, we may double count the cost of financing. Operating cash flow is where strategy becomes finance. Sales forecasts, cost structures, tax rules, and depreciation schedules all come together to estimate the cash the project can produce from operations. Taxes are central to project cash flow estimation because capital budgeting focuses on after-tax cash flow. A project that increases taxable income usually increases taxes. A project that creates deductible expenses or depreciation may reduce taxes. So we cannot stop at pre-tax operating income. We need to understand the tax consequences of the project. Depreciation is especially important. Depreciation is not a cash outflow in the year it is recorded. The cash was paid when the asset was purchased. But depreciation reduces taxable income, and that tax reduction has value. This value is called the depreciation tax shield. You will see the expression in the background. The idea is simple. Depreciation can reduce taxes, and lower taxes mean more after-tax cash flow. The timing of depreciation also matters. Earlier tax benefits are usually more valuable than later tax benefits, because cash received sooner can be reinvested or reduce financing needs. Managers should also be careful about the tax rate used in the model. The relevant tax rate is the rate that applies to incremental taxable income from the project. It may not be the same as an average tax rate from past financial statements. Tax losses require special care. If a firm cannot immediately use a tax deduction, the cash benefit may be delayed. Asset sales also create tax effects. Selling an asset above book value may create taxable gain. Selling below book value may create a deductible loss if the firm can use it. The main lesson is not that taxes should drive every decision. The lesson is that taxes affect cash flow, and project value depends on cash flow. Let's now focus on net working capital. A project may require investment not only in long-term assets, but also in short-term operating assets. Net working capital usually refers to operating current assets minus operating current liabilities. Operating current assets often include accounts receivable and inventory. Operating current liabilities often include accounts payable and accrued expenses. In project analysis, we usually handle excess cash, short-term investments, and interest-bearing debt separately, unless they are directly required by the project. Here is the intuition. When net working capital increases, cash is tied up in the project. That is a cash outflow. When net working capital decreases, cash is released from the project. Accounts receivable are a good example. A company may record sales, but if customers have not paid yet, cash has not been collected. Inventory is another example. The firm may need to purchase or produce inventory before the inventory is sold. Supplier credit can reduce the amount of cash tied up because accounts payable allow the firm to delay some cash payments. But supplier credit does not eliminate the need to model working capital carefully. At the end of a finite life project, some working capital may be recovered. Receivables may be collected, inventory may be sold, and payables may be settled. But managers should not automatically assume full recovery. Obsolete inventory, bad debts, customer returns, supplier settlements, and shutdown costs can reduce actual recovery. Working capital is one of the reasons accounting growth and cash generation can differ. A project may appear profitable, but still strain liquidity if working capital needs are underestimated. Let's turn to terminal cash flow and salvage value. Terminal cash flow captures the cash flow effects that occur when the project ends. For a finite life project, this can be a very important part of the forecast. Terminal cash flow may include the sale of equipment, property, vehicles, technology, or other project assets. It may also include tax payments on gains, tax benefits from losses, recovery of working capital, shutdown costs, cleanup costs, relocation costs, severance, disposal costs, warranty obligations, or continuing service costs. The most common terminal item is after-tax salvage value. If an asset is sold at the end of the project, the tax effect depends on the difference between the sale price and the asset's book value. You will see the after-tax salvage value formula in the background. The logic is straightforward. If the sale price is above book value, the firm has a taxable gain. Taxes reduce the cash kept from the sale. If the sale price equals book value, there is no gain or loss from the sale, so there is no additional tax effect. If the sale price is below book value, the firm may have a tax loss. If that loss is usable, it can create a tax benefit. Terminal assumptions deserve careful attention. In some projects, terminal cash flow can be large enough to change the investment decision. Managers should ask whether salvage value is supported by evidence. Is there an active resale market? Is the technology likely to become obsolete? Are there environmental liabilities? Are there disposal costs? Are there contractual commitments? Terminal value should be estimated with discipline, not optimism. Let's now compare expansion projects and replacement projects. An expansion project increases the firm's scale or scope. It may involve entering a new market, launching a new product, adding a production line, opening a new location, or building a new technology platform. For an expansion project, the forecast usually estimates the new cash flows created by the project. But managers should also consider side effects on existing operations. A new product may increase total sales, but it may also take sales away from an existing product. Those side effects are relevant because they are caused by the project decision. A replacement project is different. A replacement project substitutes one asset, process, supplier, or system for another. The firm may replace old equipment, adopt new software, automate a manual process, or switch to a more efficient technology. For replacement projects, the relevant cash flows are incremental differences. We compare the future with the new asset to the realistic future if the firm keeps the old asset. This is where discipline matters. The old asset may look inexpensive because it is already owned, but keeping it may involve higher maintenance costs, lower quality, more downtime, lower capacity, or lost revenue. The initial cash flow for a replacement project may include the cost of the new asset, changes in working capital, and after-tax proceeds from selling the old asset. The operating cash flows should also be incremental. We look at changes in revenue, changes in cash costs, and changes in depreciation tax shields. The key question is not, should we buy something new? The key question is, does switching create value compared with the best realistic alternative? After estimating the pieces, we need to build a cash flow timeline. A cash flow timeline forces the forecast to answer three questions: how much cash, in which period, and from which source. This is especially useful when a project has large upfront investment, uneven operating cash flows, working capital changes, interim capital expenditures, and terminal recovery. A practical timeline begins by setting the project life and timing convention. We need to know the forecast periods and when cash flows are assumed to occur. Next, we estimate the initial cash flow. This includes capital spending, installation, setup, and initial net working capital. Then we estimate operating cash flow for each period. This requires revenues, cash operating costs, depreciation, taxable income, taxes, and operating cash flow. After that, we include interim investments. Some projects require additional capital expenditures or additional working capital during the project life. Finally, we estimate terminal cash flow. This may include after-tax salvage value, working capital recovery, and shutdown or disposal costs. The timeline should distinguish between accounting entries and cash flows. Depreciation affects taxes, but it is not a cash outflow in the operating period. Accounts receivable may increase reported sales before cash is collected. Inventory may require cash before revenue appears. Before applying the NPV framework shown in the background, always check for consistency. If cash flows are nominal, the discount rate should be nominal. If cash flows are real, the discount rate should be real. The timeline is the bridge between the business case and valuation. Let's close with managerial interpretation and common mistakes. Project cash flow estimation is not a mechanical accounting exercise. It is a structured way to translate a business plan into value-relevant cash flows. A good forecast reveals how much cash must be committed before the project begins to generate returns. It separates operating performance from tax effects. It shows whether cash is being created by strong customer economics, tax timing, terminal recovery, or some combination. It also highlights liquidity pressure. A project can be profitable on the income statement, but still require cash for receivables, inventory, or capital spending. Managers should be especially careful with terminal assumptions. Salvage value and working capital recovery can materially affect project value. These assumptions should be based on evidence, not hope. Common errors include using accounting income instead of cash flow, forgetting taxes, treating depreciation as a cash outflow, ignoring working capital, assuming full working capital recovery without support, misstating salvage tax effects, mixing real and nominal values, and double counting financing costs. Before calculating NPV, ask a practical checklist of questions. Are the cash flows incremental? Are capital expenditures shown when paid? Is depreciation used for taxes rather than treated as cash? Are taxes based on incremental taxable income? Are working capital changes modeled correctly? Are terminal cash flows separated clearly? Are replacement projects measured relative to keeping the old asset? Are financing costs handled consistently? A mathematically correct valuation can still lead to a poor decision if the cash flow forecast is economically weak. Thank you for joining me today. I'll see you in the next video.